What if a 2% price tweak could boost your portfolio company's valuation by 40%? This sounds crazy, but it's actually very common. This is the impact on recurring revenue companies of even a small pricing change. But in SaaS companies, it's a very untapped growth lever. So today we are talking about pricing power post-acquisition, why it matters for you as a private equity company who's just acquired a SaaS company. We'll start with why pricing is critical after a buyout, and then I'll give you a playbook of what to do in order to upgrade your company's pricing. We'll talk about pricing audits, customer segmentation, packaging tweaks, and we'll also highlight many case studies of SaaS companies that improved pricing and saw big wins. Let's jump in. Why does pricing power matter? Pricing is the fastest profit multiplier in SaaS. Private equity investors like Thoma Bravo know this. They often zero in on pricing as one of the first few key levers to drive value in a portfolio company. And this is not the only private equity company that knows this. Post-acquisition, every dollar of ARR you can add through better pricing get amplified into the SaaS valuation multiples on exit. Yet, many SaaS companies underprice their product or leave money on the table with outdated models. In fact, founders are often so focused on product growth that they set and forget pricing for years at a time. The result, by the time a PE firm comes in, the product has evolved and delivered more value, but the monetization hasn't kept up. Finally, remember that pricing power compounds over your holding period. So the earlier you start, the better. Here's the bottom line. Pricing is critical because it directly drives revenue, profitability, and market value, all while maximizing the value of the product that you've invested in. Here is now a tactical playbook for you. Now that we know that pricing is such a big deal, let's talk about how to execute a pricing transformation. Here's your step-by-step playbook for unlocking pricing power in a PE-owned SaaS company, complete with real examples. At Monetizely, we have a 5-step methodology to look at pricing, starting with segmentation, packaging, pricing metric selection, price points, and finally operationalization. I recommend you take a look at a video that I will put in the description that covers this framework in more detail, though I will explain it here as well. Step 1. Conduct a pricing audit. A pricing audit examines your pricing processes, customer segments, discounting practices, and how all of this stacks up against best practice. The goal is to identify quick wins and long-term opportunities to drive enterprise value. Are similar customers paying wildly different prices due to ad hoc discounting? Is the product underpriced relative to competitors or the value that it provides? I've previously created a video on how to conduct a basic SaaS pricing analysis. I'll put the link in the description. I recommend you start with something like that as you get your hands on this. You might discover that enterprise clients are willing to pay more for premium support or some special feature that you've just been including or giving away, and that your SMB tier could actually be a higher price point. The first step is about finding where the money is. It builds the case for change. At Monetizely, we also have a tool which is an aligner product. You can use that to see where is their internal alignment or misalignment on pricing. Pricing is a topic that has a lot of different voices, and people aren't really clear on what is the highlight of things to change. If you understand where you're aligned or not aligned, that is also a good place to start. Step 2. Resegment your customers. Our experience at Monetizely is that all companies are going to go through something we call as ICP drift. At a certain point in the past, the company would have decided upon its customer segments, but then things happen. New customers come on board, new sellers arrive, new segments are found. Eventually, what you think your ideal customers across different segments are will not be true. Even the segments themselves will change. And no one likes doing this activity, so it just remains pending for years at a time. All the while, your packaging has not changed. New features are being added in an ad hoc fashion. This starts to put pressure on discounting. It leads to shelfware. It leads to a reduction in net retention rate. So resegmentation is something we really recommend starting off with right at the time you acquire the company so that you have who you are selling to. Then revisit packaging and bundling. In our 5-step framework, this is the second step. Packaging is like creating the first class, business class, and economy class sections in your airline. It is how you do price discrimination. In an enterprise company, it is possible that an enterprise may pay you $5 million and a mid-market customer may pay you $50,000 for roughly the same product. Therefore, packaging becomes super important so that you can monetize your whole customer base. We recommend checking how the packages are currently working, or even redoing packages entirely if it's been more than 2 years since your previous packages were created. Signs of packaging working are that net retention rate is high, sales velocity is where you want it to be, deal value is growing, but often the case is that when you acquire a company, this is not true. Now, for packaging, we recommend tailoring packaging to your segmentation. This could end up looking like a good, better, best model, or it could look like a very a la carte approach. Our book has more details on this, but what we don't recommend is assume on the outset that you're going to use something like good, better, best. Don't make a dogmatic decision. A cautionary tale. At a certain time in its growth, Gainsight implemented good, better, best, but it turned out that all of its mid-market customers gravitated to the middle tier. Even enterprise deals were being sold with the middle tier, and the top tier features were largely left unused, leading to a lot of shelfware. This is actually a case study in our book. We also don't recommend having no packages at all. If you have no packages, then you're not going to be able to drive NRR, you're not going to be able to expand growth, and you're going to have too high discounting. If you have too many packages, you're going to have lower sales velocity and customer confusion and maybe brittle packaging. So you need to get packaging because that is how you're going to map to the needs of the customer segments. There are many case studies in our book like Zoom, DocuSign, as well as Gainsight that I recommend reading. Step 4, the pricing metric. Pricing metric is the unit of value that your price is based on. It could be API calls per gigabyte of data and so on. Choosing the right metric is crucial because it ties pricing to the value your customers get and also make sure that you make enough money. Post-acquisition, you should ask, are we charging in a way that aligns with customer success? And are we making money when they are successful? Misaligned metrics can hurt growth. For example, a SaaS analytics tool that charges per data point stored, as a customer's usage grows more and more data is collected, the bill may keep rising. But if the data isn't directly translating to business outcome, the customer may feel punished for using the product. And this often happens. So this mismatch will lead to churn and constant complaints. A better approach is to charge for something that is more closely tied to the customer's value. Could be something like monthly active users or monthly tracked users, for example. Now, exactly what you use is really dependent on the product in question, but we do recommend checking this. Also, don't be afraid of hybrid models. You can combine a base subscription with a usage-based component on top. Very often, a common pattern is a platform fee plus a variable fee for heavy usage. For instance, if your SaaS product involves sending SMS or utilizing AI computations, you may include an allotment in each package and then charge a small overage fee per SMS or per AI request beyond that. To apply this step, audit your acquired product's pricing metric. Talk to customers or look at support tickets. Are there complaints about dissatisfaction about the way that people are being charged? Sometimes the fix is moving to a usage-based model or a tiered approach, let's say like a 3-part tariff. You buy in bundles of usage rather than just pay as you go. Other times it could be switching to a completely new metric that better aligns with customer value, like moving from charging per user or to charging per active user or charging per dollar of ads convert, for example. The right metric will align incentives between you and the customer. As they get more value, you grow and you earn more revenue. It's a win-win. Step 5, setting the price point. Now we get to the step everybody thinks about the first, setting the price point. With your segments, packaging, and metrics sorted out, now you are ready to actually look at the price points. Price setting is part art and science. It's about balancing willingness to pay, competitive benchmarks, and your value proposition. Start with the data you have. Look at your historical sales data. If previous owners did any price testing or if sales reps have been giving heavy discounts, analyze those patterns. You might find, for example, that 80% of deals closed at a 40% of discount to list price. This is indicating that discounting was rampant and policies were not being adhered to. Use this information to recalibrate prices or set a stricter discounting policy. Also consider your cost structure and margins, ensuring that price covers your cost to support with healthy margin. This is especially important in today's day and age with generative AI features where margins are very low and the inherent costs are very high. Okay, on the value front, you should consider running pricing research. A common survey-based approach is a Van Westendorp price sensitivity analysis. Basically, with a bunch of series of questions, you are able to get a range of pricing or range of price points that customers are willing to pay for a particular package and for a particular metric. Now you get a value, right? And now based on this value, you can set the right price point by comparing to your competitive benchmarks and also comparing to the sales data that you had looked at earlier. Many times customers tend to underprice. Many times companies tend to underprice. And especially if pricing has not been revised in a year or two, you can bet that so much value has been added that it begets a price point increase. And you will many times see that customers accept these increases without any churn. The lesson: don't be afraid to raise prices if your value supports it, especially post-acquisition where a young company might have underpriced to land early customers. With better positioning and a proven ROI, you can often move up price points confidently. Step 6, operationalization. Now, you've designed this new pricing model and now you have to implement it and make it work day to day. This final step, operationalization, is where many pricing strategies succeed or fail. The greatest pricing model means nothing if your sales team can't execute it or your systems can't handle it. Post-acquisition, there is often work to do here, especially if the company was a scrappy startup with informal processes. Key aspects of operationalizing pricing include systems and tools. You need to update billing systems, CPQ systems, and potentially the product itself to support the new pricing. For example, if you introduced a new usage metric, your product and billing platform must track usage accurately. Don't underestimate this. If your team can't quote the new pricing quickly, say a new CPQ with the latest packages, or if invoices go out wrong, it will derail customer trust and sales confidence. Invest in the infrastructure so that quotes, orders, and bills all align with the new model. Next, sales enablement. Your sales rep and account managers need to be trained and armed to sell the new pricing. This means internal documentations, cheat sheets, ROI calculators, and maybe even reworking sales pitches. Without enablement, reps might resort to old habits, deep discounting, or selling outdated packages, which can sabotage the strategy. And I've been there many times. Reps do this. Consider setting up a deal desk or approval process for transition period. For instance, require any deviations to be approved from a higher level CXO. This helps enforce new structure and prevents ad hoc discounting that undercuts your work. Finally, policy and governance. We touched on this a little bit, but you need to establish clear policy for discounting, renewals, exceptions. Who can approve a discount beyond 10%? You need a discounting matrix and allowed thresholds for different people. Who will approve a new feature for an existing package or an exception? You need guardrails so that your pricing doesn't devolve into Wild West negotiations. And a common mistake is to design new pricing but not adjust or change discounting policy. So then giving too much latitude to sales is not a good idea. So tighten that up and communicate it properly. Finally, customer communication and change management. If existing customers will be affected, then you'll have to plan that communication carefully. You don't want this to trigger unnecessarily churn. And you should consider grandfathering customers as well, because you have to consider, are customers going to make the change or is there going to be a customer revolt? And you don't want a customer revolt. Sometimes operationalizing means rolling out changes in phases. New customers on new pricing immediately, then phase in changes for renewals over the next year with plenty of notice. All right, we've covered all of the steps from understanding segments to executing the strategy. To cement this, let's quickly recap some common pitfalls that I'd like you to watch out for. Before you rush off to implement your pricing transformation, be aware of a few pitfalls that PE firms and SaaS companies often encounter. Avoiding these will save you headaches and protect the value you're trying to create. Number 1, misaligned stakeholders and goals. Don't skip the upfront alignment. If your executive team isn't on the same page about who you're targeting and what you're trying to achieve, it could be growth or profitability, your pricing project will run into constant friction. For example, if the CEO expects pricing to drive up market expansion, but the CRO is still pushing volume deals to startups, you've got a problem. Align on the strategy first to avoid this internal tug of war, and this is the number one death knell for all pricing projects. Number 2, one size fits all packaging. Be wary of using the same package for wildly different customer segments. As we saw in the Gainsight story, packaging that doesn't fit the customer will fail. You'll either have an offering that's too expensive for one segment or too cheap for another. You might have a middle tier that everyone buys while the other tiers collect dust. The pitfall here is creating shelfware. Giving people features that they're not going to use, and conversely, leaving valuable features out of reach and losing upsell opportunities. Tailor your packages and bundles to each segment's needs and willingness to pay. The other thing is sudden or unearned price hikes. Private equity owners are often eager to raise prices, gotta boost that ARR, but beware of jacking up prices without adding new value or without clear communication. Customers are ignorant. If the same product and features are available for a lower price somewhere else, they will move. And software, you should understand, is the most highly deflating market, not inflating market. As SaaS veteran Jason Lemkin observed, annual price increases on the same product can erode goodwill. It's better to introduce higher pricing for new customers who can choose to buy or not, and find ways to gradually upsell and expand existing customers with added value. If you do need to raise rates for current clients, communicate the improvements or roadmaps that justify it, and consider grandfathering or phased increases to ease the transition. Finally, poor execution and rollout. A great pricing strategy can fall flat due to poor implementation. This includes failing to train the sales team, resulting in rogue discounting or confusion, not updating the website or materials, or technical glitches in billing. Avoid these by treating the rollout as a project in itself. Equip your team, update all customer-facing channels, and keep a close eye on results. In short, operationalize properly. It's not the fun part of pricing work, but it is absolutely crucial. By keeping these pitfalls in mind, you'll steer clear of common traps. In conclusion, pricing can be your secret weapon in driving post-acquisition performance. For PE firms, the message is clear. Don't leave pricing on autopilot after a SaaS company's acquisition. With a structured approach, you can often unlock significant growth and profitability relatively fast. Have you tried to adjust pricing at one of your portfolio companies, or are you facing a pricing challenge right now? We'd love to have a talk and even help with your pricing audit. Our pricing assessments are free, and I will post a link to the pricing assessment in the description so we can help. Thank you so much for your time.